Welcome to this explainer. Today, we're putting one of the absolute hottest stocks in the entire market through a rigorous investment obstacle course. Everyone is talking about the incredible medical breakthroughs happening right now, but as expert investment analysts, our job is to separate the hype from the cold, hard numbers. So let's get into it. We're diving right in with Eli Lilly. This is a 150-year-old pharma giant that is practically taking the market by storm right now in mid-2026. They are sitting at the absolute epicenter of the metabolic health revolution, primarily through their incredible incretin-based therapies for obesity and diabetes. But hey, as we know, a great company doesn't automatically make for a great stock, right? And wow, this number perfectly illustrates the stakes here. Sitting at a massive, massive share price of over $1,142, we really have to ask ourselves, is this high flyer actually worth the premium? Are investors buying into sustainable long-term cash flows, or are they just chasing an insanely strong momentum wave? So here's the gauntlet we're running today. We're going to perform a complete stock analysis by putting Lilly through the frameworks of legendary investors, Warren Buffett, Peter Lynch, and Benjamin Graham. Then we'll run it through classic financial modeling, like discounted cash flow, to try and pin down its true intrinsic value. Okay, part one. Let's just grab a quick snapshot of exactly why Eli Lilly is commanding so much attention right now. Just look at this sheer explosive growth. It is absolutely fascinating. We're talking about a 48% jump in year-over-year Q2 revenue that brings them to roughly $23 billion. And this isn't some theoretical projection. This is driven heavily by the massive real-world volume of their key products, Mounjaro and Zepbound. Plus, their non-GAAP earnings per share shot up 33% to $8.38 for the quarter. That kind of performance allowed them to confidently raise their full-year guidance to a midpoint of roughly $36 a share. And honestly, leadership is incredibly confident right now. They've got next-generation weight loss medicines like Retrutudide completing clinical data packages, and they just committed a fresh $4.5 billion to expand manufacturing in Indiana. The future looks bright, for sure. But let's see how this incredible operational success actually holds up to the first of our legendary investment gurus. Moving right along to part two, let's run this stock through the highly distinct investment lenses of Warren Buffett and Peter Lynch. First up, Warren Buffett. Now, we know Buffett looks for a few key things: a wide economic moat, consistent owner earnings, high return on equity, and honest management. And Lilly? Well, they absolutely passed the moat test, thanks to that massive first-mover advantage in GLP-1 drugs. Management is allocating capital efficiently, and earnings are surging consistently. But, and this is a huge but, Buffett's golden rule is a strict margin of safety. At over $1,142 a share, this stock is priced for absolute perfection. So Buffett would almost certainly sit on the sidelines, just waiting for a significant drop to get that required margin of safety. Now, let's flip the coin to Peter Lynch. Lynch classifies companies into specific categories, things like stalwarts, slow growers, or fast growers. Given Lilly's current trajectory, Lynch would undoubtedly label them a fast grower. And to evaluate those, he relies heavily on the PEG ratio. That's basically just taking the price-to-earnings multiple and dividing it by the company's earnings growth rate. So let's run the numbers together. Using their updated full-year guidance of roughly $36 per share, the PE ratio sits near 31.7. Normally, that sounds pretty expensive, right? But wait, because their non-GAAP EPS growth is a staggering 33%, the PEG ratio actually comes out to right around 1. For Peter Lynch, this is the magic number. It indicates that a fast-growing company is fairly valued relative to its explosive growth. He'd likely view this as a highly attractive fast grower buy. All right, part three. The growth investors clearly love it, but what happens when we apply the strict, ultra-conservative rules of Benjamin Graham? Under Graham's defensive investor checklist, Lilly's financials are an absolute fortress. They easily pass the adequate size test with over $85 billion in projected annual revenue. And they pay a very reliable annualized dividend. But those astronomical valuation multiples, total deal breaker. Immediate fail. If we run Graham's strict intrinsic value formula, even if we assume a pretty generous industry standard book value of around $15 to $20 for a legacy pharma company, the model spits out an intrinsic value well under $200, literally under $200. For a strict value investor like Graham, it's a hard pass. Okay, part four. Let's step into the analyst lab and build out a formal discounted cash flow, or DCF model, to strip away the hype. We really want to look purely at the future cash this business is going to generate.
To do this, we're going to explicitly assume a robust 20% free cash flow growth for the next 5 years. Now, that's a very aggressive assumption, but it's totally justified given the massive runway for their diabetes and obesity portfolio. Then we calculate a terminal value based on perpetual growth. And finally, we discount all of that back to present-day value using the weighted average cost of capital, or WACC.
So when we run a sensitivity analysis on those assumptions, let's use a standard industry average WACC of 9% and a 3% terminal growth rate. Our base case DCF yields a fair value of roughly $785 per share. Actually, even if we push some highly optimistic inputs, like an 8% discount rate and 3.5% terminal growth, we still max out at $950. The takeaway, in basically every realistic scenario, the intrinsic value falls well below the current $1,000 plus trading price. Which brings us to part 5. If the DCF doesn't support the price, can alternative valuation models somehow justify this premium price tag? To test this out, we're going to apply 2 more models based on the source data. First, the dividend discount model, which values a stock based purely on the present value of its future dividend payments. And second, a comparable PE analysis benchmarking Lilly against industry peers like Amgen and Gilead, who are also highlighted in the sector reporting. And the results here are heavily split. The DDM severely punishes the stock for its relatively low dividend yield, placing fair value somewhere in the $450 to $550 range. On the flip side, the comparable multiple analysis, which factors in those premium multiples often assigned to high-growth pharma, gets us much closer, projecting a value between $900 and $1,050. Yet even this more generous comparable model still trails the massive market momentum that pushed Lilly over $1,140. All right, we've made it to part 6. Let's synthesize all of these distinct valuation frameworks into one master scorecard. And wow, this brilliantly illustrates the divide in the market right now. Look at this. Wall Street analysts have an average target of nearly $1,300, and Peter Lynch's PEG framework sees a justified growth engine screaming buy. But traditional financial physics strongly disagree. Base case DCFs sit around $785, and Benjamin Graham's strict metrics are basically calling it entirely overpriced at anything over $200. It's a true battle of philosophies. Ultimately, investing isn't just about the math. It's about business realities. And the fundamental reality here is that Lilly has an impeccable business and pipeline. That first mover advantage is massive. And their drugs are now showing efficacy for broader conditions like sleep apnea, which is huge. But we've got to weigh that against the real-world risks: intense competition from companies like Amgen, persistent supply chain bottlenecks, and the looming regulatory risk of Medicare price negotiations under the Inflation Reduction Act. So the crucial point we have to answer is, at what price does this undeniably great business actually become a great stock to buy? Well, for Lynch, it's a buy today. For DCF purists, it becomes a buy around $785. For Buffett, he likely wants a margin of safety below that, maybe somewhere around $600. And for Graham, honestly, he's simply looking elsewhere entirely. So based on our complete analysis of all the provided sources, our final verdict is sharply split. If you follow Peter Lynch and Wall Street momentum, you're riding the wave and banking on their clinical pipeline continuously exceeding expectations. But if you demand Warren Buffett or Benjamin Graham's margin of safety, you are firmly in the hold or sell camp, literally waiting for a major market correction before even touching the stock. This leaves us with one final provocative thought for you to chew on. The business of Eli Lilly is undoubtedly changing the world. But in the financial markets, price is what you pay and value is what you get. Will Eli Lilly continue to outrun its astronomical valuation through sheer unprecedented growth? Or is a painful reality check just around the corner for investors who completely ignored the margin of safety?